Sometimes you just want to cut through all the noise, right? Get straight to what's important without wading through pages and pages of reports.
Exactly. It's about understanding the big picture quickly.
Well, that's precisely what we're aiming for today in this deep dive. We're focusing on Eternal Limited. You probably know them better as the Mado.
Mm.
We've got their latest shareholder letter. It's dated May 1st, 2025, plus their financial results for the last quarter and the full year ending March 31st, both consolidated and standalone.
And there's also that monitoring agency report on how they're using the funds from their QIP, the qualified institutional placement.
Right. So our mission here really is to pull out the key insights from all of this. What's happening with Eternal's performance across their different bits, food delivery, Blinkit's quick commerce, going out, and Hyperpure, their B2B side.
And also sort of understand their strategies. It's a tough market out there. And of course, the money side, what are the financial implications of everything they're doing?
Okay, let's dive in. Starting with the big numbers for Q4 of their last financial year. One thing jumped out at me straight away. They're talking more about net order value, NOV, instead of gross order value, GOV. Why the chains?
Yeah, that's interesting, isn't it? It tells a story. It seems like Blinkit isn't just about groceries anymore. They're selling a lot more non-grocery stuff. And these items often have a high MRP, the sticker price, but the actual selling price after discounts is lower. So GOV based on MRP was maybe making things look a bit inflated.
Okay, so NOV is closer to the actual cash register ringing.
Exactly. It's the amount customers actually paid, much more grounded. And they're using NOV across food delivery and going out too now for consistency. So yeah, the growth percentages might look different, but it's a better view of what customers are actually spending.
Got it. Makes sense. So measured by NOV, how did things look in Q4 overall?
Pretty strong, actually. For the B2C businesses combined, that's food delivery, quick commerce, going out, NOV was up 53% compared to the year before.
Wow.
And 5% up from the previous quarter, reached about INR 17,440 crore.
Okay.
And even if you strip out the PTM ticketing business they bought, the like-for-like growth was still really healthy, like 48% year-on-year and 5% quarter-on-quarter.
And the B2B side, Hyperpure.
Also flying. Revenue there jumped 93% year-over-year and 10% quarter-over-quarter. So overall, the consolidated adjusted revenue that grew 60% YoY and 8% QoQ, hitting INR 6,188 crore.
So revenue is definitely climbing, but I did spot that their consolidated adjusted EBITDA actually went down. What's happening there?
Yeah, that's the trade-off, isn't it? It highlights their big bet right now. Revenue's up, sure, but the adjusted EBITDA fell by 15% year-over-year in Q4, down to INR 165 crore. The main reason, they really ramped up spending on expanding Blinkit, the quick commerce stores, a huge investment push.
Okay.
Now, it was partly offset by better performance in food delivery. Their adjusted EBITDA margin there, as a percentage of NOV, actually improves, went up to 5.2% from 3.8% a year ago.
So spending big on quick commerce, hoping for future gains, even if it hurts profits now.
That seems to be the strategy, yes.
Yeah.
Short-term pain, potentially long-term gain in that fast-growing quick commerce space.
Yeah.
We'll have to see if that investment pays off into market leadership.
Let's zoom right in on Blinkit then. Those EBITDA losses got bigger in Q4. You said aggressive store expansion. Just how aggressive are we talking?
Yeah, well, they properly went for it. Blinkit added, wait for it, a record 294 net new stores just in Q4.
Wow, in one quarter.
Yeah, and get this, about 40% of their entire network, which is now 201 stores, were actually opened in just the last 2 quarters.
That's a lot of new stores very quickly.
It is, and they added about 1 million square feet of warehousing space, too, to support it all. So naturally, a lot of these new stores are still ramping up. They're underutilized for now.
So it definitely looks like Blinkit's priority is just scale, scale, scale right now, not profit.
Absolutely.
Yeah.
They've said pretty clearly that profitability in quick commerce isn't the immediate focus. Those losses might bounce around a bit, depending on how fast they keep expanding and what the competition does.
Yeah.
Their long-term aim for adjusted EBITDA margin there is like 5–6% of NOV.
Yeah.
But what's kind of interesting is, despite all this spending, their contribution margin, that sort of profit per order before big long-term costs like new warehouses, it actually nudged up slightly from 3.8% to 3.9% of NOV.
Okay. And all these new stores need customers. Did pumping money into marketing help?
It looks like it. Their average monthly transacting customers on Blinkit jumped quite a bit, went up to 13.7 million in Q4 from 10.6 million in Q3.
That's a decent increase.
Yeah, it suggests the marketing push is bringing more people onto the platform.
The letter also talks about competition getting tougher in quick commerce. Who are they worried about?
Well, it seems like it's coming from two directions. The
Okay.
existing quick commerce players, obviously, but also the traditional next-day delivery companies who are now trying to speed things up, especially for non-grocery items where the margins are maybe a bit better.
Right, everyone wants a piece of that action.
Definitely shaping up to be a key battleground.
So, with all that going on, the expansion, the competition, what are Blinkit's immediate priorities? What are they focusing on day to day?
It seems to be two main things. First, just getting the customer experience right. Consistent, reliable delivery and fulfillment. Making sure orders arrive correctly and on time.
Uh-huh. Crucial.
Absolutely. And second, they want to offer a much wider range of stuff on Blinkit, more product categories. They think that combination great service and lots of choice is the key to winning customers long term.
Now, this whole Indian-owned and controlled company, IOCC status, that sounds significant. How could that change things for Blinkit?
Ah, yes. This is quite a strategic move. Becoming an IOCC basically gives them the option to own the inventory themselves in quick commerce.
Oh, okay, so moving away from just being a marketplace.
Potentially, yes.
Yeah.
Right now, they're mostly a 3P or third-party marketplace connecting buyers and sellers, but not owning the goods. IOCC status opens the door to a 1P or first-party model, where they buy, store, and sell the inventory directly, or maybe a hybrid.
So they might actually start holding stock in those warehouses.
It's definitely on the table now. They haven't laid out the exact plan yet, whether it'll be fully 1P or a mix. They said they'll share more details, including how much money they might put into inventory after they get shareholder approval.
Right.
But they did give a sort of hint. They suggested that even if Blinkit owned 100% of its stock in FY25, the working capital needed might have been less than INR 1,000 crore.
That actually sounds lower than I might have guessed, given the scale.
Yeah, it's relatively modest compared to the total NOV. The idea is that owning inventory could potentially help their margins down the road, better control over sourcing, pricing, that sort of thing.
Makes sense.
But they also admitted that any gains might be offset, at least initially, by all the competitive pressure. Oh, and one other thing, they were very clear. No plans for private label brands right now, even if they do start owning inventory.
Okay, interesting. Let's pivot to the core business, food delivery. The letter suggests growth there has slowed down a bit, below their usual 20% target. What's behind that?
Yeah, they flagged a few things. First, just a generally sluggish economy affecting discretionary spending, like ordering food, people being a bit more careful with their money.
Felt across the board, maybe.
Possibly. Second, they mentioned a temporary shortage of delivery partners. Seems the huge demand from quick commerce might have pulled some riders away.
Competition for gig workers, too.
Exactly. And then there's competition for quick commerce itself, with platforms now delivering packaged foods, which nibbles away at some restaurant orders.
Okay, so those are sort of external market factors. Were there internal things, too?
Yes, definitely. A big one was their decision to delist about 19,000 restaurants.
19,000, why?
For various reasons, hygiene standards, brands mimicking others, misleading listings. They said it was necessary for platform quality long term, but obviously it hit order numbers in the short term.
Right, that would have an impact.
And there was one less day in Q4 FY25 compared to the previous year, or leap year. They reckon those two factors, the delistings and the shorter quarter, probably shaved about 2 percentage points off their growth rate.
Despite these bumps, are they still bullish on food delivery long term?
Oh yeah, they seem quite confident. They stress that they don't see any deep structural problems causing the slowdown. They point to the fact that online food delivery still isn't that widespread in India, plus rising incomes, more people moving to cities. Those underlying trends are still strong.
And market share.
They believe it's held steady despite the competition, and they're hoping to gain more ground going forward.
So how do they plan to get that growth back up towards 20% plus?
3 main levers they're focusing on. Wider assortment, just more choice on the platform, better affordability, making it cheaper for users, and lower delivery times, getting food there faster. They're apparently running lots of experiments around these areas.
And a leadership change, too.
That's right. Deepinder Goyal, the CEO, is stepping back in to head up food delivery directly. Rakesh Ranjan had been leading it for the past couple of years.
What about those newer ideas they tried, like Zomato Quick and Everyday? Are they still going?
No, they've actually shut those down. Zomato Quick, the 10-minute delivery thing, apparently struggled with consistency because of restaurant kitchen limitations.
Yeah, 10 minutes always sounded ambitious.
Right. And Everyday, which offered sort of home-style meals, apparently only really caught on in office areas in big cities. Not a big enough market, they decided. Couldn't see a clear path to profit without compromising the experience. So, yeah, pulling the plug on those. Shows how tough it is to find the right new models.
Okay. Shifting gears again, let's talk going out. They're moving this all over to the District app, right? How's that going?
Seems to be progressing steadily. In Q4, about a third of the going out order value is already happening through District. They expect the full switch in the next quarter or two.
And then it's District only.
Yep, that's the plan. They're still investing in getting users moved over and adding more options, especially live events. Just remember, though, when looking at the going out numbers since mid-last year, they include that entertainment ticketing business they bought. So comparing with older periods isn't quite apples to apples.
Got it. Okay, Hyperpure, the B2B side. That non-restaurant part seems to be growing incredibly fast.
Yeah, it really is. That segment, which is mostly selling fresh food and staples to the sellers on Blinkit, it grew over 150% year-on-year in Q4.
Wow.
And it's already close to breaking even on an adjusted EBITDA basis, largely riding the wave of quick commerce growth, of course. But because it's more like straightforward B2B trading, they're still figuring out what the long-term profit margins might look like.
And the original Hyperpure business supplying restaurants, how's that doing?
Still growing steadily, around 35–40% year over year, but it's currently running at a loss, about 93% adjusted EBITDA margin.
So still needs work.
Yeah, but they're investing there too, trying out new things for restaurants, value-added ingredients, faster deliveries between cities, even looking at managing logistics for them. The idea is to get restaurants more engaged and eventually improve profitability. The letter actually breaks down the revenue split between the restaurant and non-restaurant parts for the last 5 quarters, which is helpful.
Let's look at the overall company financials for the full year ending March 31st, 2025, the consolidated view. What stands out?
Well, the big headline is revenue from operations. Jumped significantly to INR 20,243 crore for the year. That's up from just over 12,000 crore the year before.
Huge growth.
Massive top-line growth. But reflecting those investments we talked about, the profit attributable to owners was actually down. INR 39 crore compared to INR 175 crore the previous year. Same story for total comprehensive income. INR 78 crore versus INR 215 crore. So earnings per share, basic and diluted, were quite small at INR 4.04 for the year.
But they're sitting on a lot of cash.
They are. Ended the year with a very healthy INR 10,920 crore in cash and equivalents.
And a big chunk of that came from the QIP, the share placement.
Exactly right. They raised INR 8,500 crore through that QIP during the year, issued over 336 million shares to institutional investors at INR 252.62 per share. Gives them a lot of financial flexibility.
What about the standalone numbers? Just Eternal Ltd itself, without the subsidiaries rolled in?
Right, looking just to the parent company. Revenue from operations was INR 8,617 crore, up from 6,622 crore. But interestingly, the profit on a standalone basis actually increased INR 1,960 crore compared to 1,371 crore the year before.
Oh, that's different from the consolidated picture.
It is. And total comprehensive income was also up, INR 2,091 crore versus 1,421 crore. So the standalone earnings per share were much higher, INR 2.22 basic and INR 2.15 diluted. It really shows how the different parts of the group contribute financially. Standalone cash was INR 368 crore, and they also noted issuing quite a few shares to their employee stock option trust.
Okay. Anything else significant? Any regulatory issues mentioned?
Just a brief mention. They received some demand orders from GST authorities in Maharashtra and West Bengal. It relates to delivery charges collected way back between late 2019 and early 2022.
Right.
They've appealed against these orders. They say they've got external expert advice backing them up and believe they have a strong case. So, something to watch, but they seem confident.
And finally, that QIP money, how are they actually using the INR 8,500 crore they raised? The monitoring report covered that, right?
Yes. iSiri Limited, the monitoring agency, gave an update. Good news for investors, they found no deviations. The money is being used as promised.
Okay.
The main buckets were setting up and running dark stores and warehouses, mainly for Blinkit, advertising and marketing across the board, investing in tech, and general corporate stuff.
And have they spent it all?
Not yet. The report details how much was planned for each area and how much has actually been spent. There's still an unutilized chunk.
And where's that sitting?
It's parked safely for now. The report lists investments in various fixed deposits, corporate deposits, government securities. It details the amounts, maturity dates, returns. Pretty transparent. A large portion is in FDs and government bonds. And importantly, the agency says the rollout of the plans funded by the QIP is on schedule. No delays reported.
Okay, so let's try and wrap our heads around this. The big picture seems to be Eternal doubling down on growth, especially with Blinkit and quick commerce. Huge investments there,
Yeah.
accepting losses for now in a market that's getting way more competitive.
Right. Meanwhile, food deliveries hit a bit of a speed bump, partly market conditions, partly their own strategic moves like delisting restaurants, so they're trying new things to reaccelerate that.
And going out is moving to the District app. Hyperpure is booming thanks to Blinkit. And they've got that big pot of QYP cash being put to work strategically.
That sums it up pretty well. Which leaves us, and you listening, with a really interesting question to ponder, doesn't it? With all this intense competition and these major strategic bets, especially in quick commerce, how exactly will Eternal manage that balancing act, driving that aggressive growth they want versus actually achieving sustainable profits across all these different businesses in the long run?
Yeah, that's the multi-billion-dollar question, isn't it? A
Yeah,
fascinating puzzle to watch unfold.
absolutely.
If you want to dig even deeper into the numbers and read the full reports yourself, you can usually find them on Eternal's Investor Relations website.
Definitely worth a look if you have the time.
And please do join us again next time on The Deep Dive, where we'll tackle another key topic we know you're interested in understanding better.